What is going on, ladies, gentlemen? Let me turn the music down a little bit here. We're getting into Halloween here. I figure there's nothing more scary than the bears. So today I want to talk about taking some profits and actually utilizing some of the cash that's within my corporate account. But we got a lot to get into. Yeah, I hope you guys like the jetpack costume. For those of you just popped it, I'll show you one more time. This is like probably the coolest costume I've got in a while, right? Like, look at this shit. Okay, how good is this? I can like waddle over. How good is that? I love it. Yeah, baby, we're going to the moon. Who's joining me? So what I want to do this evening is we're just going to break down some Q&As. We're going to talk about what's going on here, folks. And then I just want to kind of dive into exactly why I'm going to start converting some of my U.S. currency into Canadian currency, just to start doing some stuff, paying the mortgage down a bit, also topping up our TFSAs. I'm going to get into a bit more details behind that. Sup, peeps, what's going on? We got Looney in here. Thoughts you were duct taped to a chair. Yeah, this is super awesome. Yeah, my favorite holiday as well. We've been out doing Halloween stuff all week. And I just wanted to share the costume. I'm kind of annoyed because Halloween doesn't fall on next weekend. So I'm like, everyone's celebrating this weekend. So I wanted to try the costume out. Oh, that's hilarious. Yeah, appreciate you all stopping in. So let's get into this by first and foremost. I might take this down. We'll leave it on for a bit. I'm sure you guys can't hear the fan, though. It's pretty loud in my ear. Sold half of Enbridge and Royal Bank. Oh, you're taking profit on the Canadian side of the border, eh? So let's just dive right into this. First and foremost, just to break down some of the Q&As, because someone said you are definitely my favorite finance YouTube channel, but I still think you probably need at least $1 million CAD account to retire comfortably in Toronto. Even with a frugal lifestyle, especially if you are thinking about raising a family, with $1 million, you can get $50K per year in dividends safely. Which should be enough only if you have no mortgage. And I think this is debatable. Like, obviously, if you have kids, this is going to become a little bit more expensive. But I think I was talking about like maybe getting 600 to 800K would be enough for us to have that kind of like FU money sort of a thing that we've been discussing, right? Like actually buying back your total freedom. Because I think it depends on your cost of living, which were some of the comparable questions that were coming up. Because someone was talking about in our chat group what they're paying for, like even just house insurance costs a lot more for liability and all that stuff compared to like a condo that we have. So if we pay off our condo, I think comfortably we'd get away with like 600K would probably be like the bare minimum for us to be comfortable. But it depends. If you own a house, a multi-million-dollar home, insurance is more, property taxes more, all that is more, right? But we got a wonderful, condo here, so it's not nearly as pricey. Looking for a decent Trump wig myself. Who we voting for, boys? Girls, who we voting for in this election? You're going to get spicy right off the start here. I got a bet on me and my buddies and their parents are completely divided down the middle on who's going to win. So there's three of us. We made a bet against each other, and because it's split evenly, like we all just kind of piled in some cash and said, look, like three of us are going for Kamala, three of us are going for Trump. We're just going to try and have some fun with it. I can't get over how divided the U.S. elections are, man. Even like in Canada, like we're divided on who's going to win in the U.S., yet we're all so confident in Canada. Like our politics, people don't seem to want Trudeau. Like it's become like a unanimous agreement that most people that voted him in do not want to vote for him again. So it's going to be hilarious live. I love it. Thanks for dropping in, Trump. Hopefully, we got a Trump fan in here. I don't want to get too divisive. Like I'm not the biggest fan of Trump. I'm voting for Kamala, but I'm not going to be like as divisive as like, oh my God, the stuff like the rhetoric in TikTok and the media and all these political debaters. It's like life or death situation right now over there. Even when I play games internationally, everyone's like, why can't we just vote on the U.S. election? It affects all of us anyways. I can't wait for the election to be over. I hear you. I mean, yeah, and it's crazy too, because we still might get one this year in Canada. So it's going to be a wild year to finally get it out of the way for another 4 years. So we don't have to argue about it. If you live in Canada, who cares about the U.S. election? Oh, come on. Everyone in Canada discusses it, bro. Everyone. I got a lot of friends in the States too, so it's always an interesting discussion. Politicians are all the same. Yeah, they're a bunch of liars. They all lie. It's horrible. It's horrible. I'll read one more comment here. Both next year. Yeah. Anyways, getting into this, somebody else pointed out I own a house and I only have 100K left on the mortgage. The house is worth 250K. Should I remortgage my house to put 150K in the market, specifically VFE? I'm only 30. And my current rate is 1.64% on a 5-year fix, which congrats on that absolutely insane rate. However, this is an interesting question for the chat. What do you guys think? Would you guys refinance your house if you had such a low rate to put it in the markets? I think the thing that always concerns me the most is past performance doesn't represent future return. And I hate debt with a passion. I'm more on like Dave Ramsey's side with that. Though logically, if you're looking at like a 20 to 40 year time horizon and you got a long mortgage, that's even like Warren Buffett, right? Like I think there was a story of Warren Buffett where he held off buying a house because he didn't want to give up that much capital because it was basically like his toolbox and the house would take away from too much of that. Whereas I'm still more in the camp, for me personally, of I don't want, the way we kind of did it is like we want half our assets in the market and half our assets in real estate. Right now we're almost evenly split between the, like, not with the liability of the mortgage, but just with the like our asset minus liability in the property. So the amount that we put into the property and the amount we have in the stock market between me and my fiance are almost 50-50. So that's where I wanted to get before I started paying it down a bit more aggressively. I think it's just your risk tolerance, but man, I don't know if I personally have the balls to, dump that, just go out and mortgage it. And even still, like if you were to finance it now, you're not going to get, you're not going to get it financed anywhere close to 1.6%, anything you're pulling out of the property. Is that how it works anyways? I don't think you can pull it out at 1.6 if you were to get a house back line of credit or a mortgage or something off the back. Refinance only if your VFE would be in a tax-free savings account. Yeah. I just hope once the election ends, we can get back to life and the market. Yeah, it's crazy, man. There's going to be a lot of big effects though, I think, especially with like the Trump and Elon thing, which I think is super weird. I really wish Elon didn't get involved in the politics, but at the same time, it's like, bro, if Trump wins, like having, your hand directly involved in like policy as a CEO, how crazy that would be. It's again, I don't know if it's kind of a good and a bad thing. I don't know. If someone can make more in the market, then it would be tempting, but I choose to pay off my mortgage and it feels great. I feel I can focus on investing. You have a paid for mortgage. Congrats. Or do you, but you choose to pay it off. Or you chose to pay off my mortgage and it feels great. So did you pay it off? Holy shit. Congrats if you did. I think Trump will affect crypto greatly. We shall see. We shall see. This is a fun conversation, man. It's a nice back and forth between like realism and the election insanity. Where are you currently parking your small cash position? Is it just sitting in your account, or do you stick it in a money market fund until you see an opportunity? So my cash, I actually have a lot more cash than I show on my my portfolio here, and the reason because of that is that we have a shared joint account just for the mortgage and property expense and all that stuff. And it's a rather large cash account, and we don't have it in high interest or anything. It's just sitting there. But the reason we build it up is because we're going to obviously pay down the mortgage a bit earlier. We build it up, and any cash that I look at using in the next like 1 to 3 years, I'll typically not, I don't even care where it sits. I don't really have any of my cash except for what I owe the government and taxes and high interest savings right now. But otherwise, because I move my cash around so much, and the problem is it's divided between so many accounts, because I think we're using like 4 different banks. And I have a corporate account that's part of this cash. I have my regular investing account that's part of this cash. We have obviously the mortgage account and all that other stuff. So when it comes to my cash position, honestly, it's just one of those things where I always keep like a barrier just so I don't have to pay like the stupid minimum fees for a bank, because I hate that they charge you minimum fees if you don't have like, minimum 3K or whatever it is. But now they're coming out with accounts where I don't think you have to have minimums. But honestly, if I had that much cash and I was just using it as an emergency fund purely, and it was like all in one account, like if I had this 16 grand in just one account, I would put it in a high interest savings or lock it up in, a GIC that's cashable at any time. Would probably be my best bet. I've been dropping some cash into VDY and SCHD. I still think these are fairly favorable. They'll go down if the US market goes down, and I want to get to that conversation in a minute. We'll just answer a few more Q&As here, and then I want to talk a little bit more broadly, just kind of about what I'm going to do with cash and why I'm going to probably take some profit off the S&P. But love the video. I hope I won't have to work by 35 as well. Just got to keep saving and investing. I'm 23 years old, and I have about 30% of my portfolio in Canadian stocks and the rest in the US. That's fairly balanced. I think you probably got a bit more CAD than we do. That's a nice balanced portfolio. Would you recommend just investing in the US for better returns? Yes. And so here's the dilemma. Like I am primarily, and even a little while ago there, like I was pretty much 100% US stocks, which again, we're going to come down this conversation, and it's a tough conversation right now because the Canadian dollar has become like super unfavorable. So it's really hard to convert the currency over. And I know you don't think, like, you don't feel it if you're buying VFV, let's say, but you're still really converting the currency even when you're buying, the Canadian CAD denominated S&P 500 or whatever you're buying. But yeah, that's a tough opinion. Honestly, probably global market funds are better for most people, in my opinion, because the currencies just fluctuate so much. But having Canadian dollars right now is the worst, which again, we'll talk about. But we were talking about earnings a lot. And if the market is kind of overvalued here, Newmont posted its highest quarterly profits in 5 years, but the stock dropped 15% because of rising costs. And this is what we were saying, that, even though these earnings are kind of coming in good, a lot of these companies are, well, first Newmont, I mean, obviously in the precious metal sector, which is exploding, but CN Rail we covered, right? They're doing a lot of share buybacks, like record share buybacks, because the revenue really isn't growing as much. A lot of companies have been refining. Like during this whole interest rate cycle, as we've discussed, companies went through this phase, right, where they were like, we saw revenues slow down for a bit, and they knew the only other option they have was, okay, we can lay people off, we got to cut costs, we've got to increase, margin again, and then we also should do share buybacks. So if revenue doesn't explode, at least we can keep increasing the earnings per share. And that's really what we saw, right? Now we're kind of getting we came out of the eye of the storm, and now we're in this final phase of the interest rate cuts, which is very messy. It's just as messy as going into the interest raise. And it's going to be really neat to see how the economy handles this. But yeah, it's like I said, these companies, they're posting good numbers, and it's nice. The stocks are coming down. They're not great numbers. They're not numbers like they were posting before. But my concern was they're trading at wicked high valuations, right? And it's neat to see companies posting really good earnings, but the stock's actually going down. We saw with Coca-Cola, a bunch of these companies are posting very reasonable earnings. But as we discussed, and I want to get into this because somebody asked me too, like, hey, do you have any thoughts on SCHG? I would love to hear about that from you. It's basically the US large caps, which comes from Schwab, which basically benefited the post-2008 era. If we say we are bullish on the market, why not go all in this with this versus VOO? It's significant performance difference. Thoughts? Yeah. So right now, I think, tech, if you're a long-term investor, like biometrics, obviously not investing in tech has been a horrible thing to bet against over the last decade. But like I've always have this itching concern is that things, again, past performance doesn't equal future return. And I have exposure to these companies. I will not stop cost averaging into these companies, but my stomach at the scale of my portfolio these days is a hard time handling like valuation and just like numbingly buying just infinite growth, knowing that we're in very weird times. I mean, again, 2009 to like 2020 was the era to be alive in investing. Things were congruent. There wasn't so much insanity going on in the world. Like it was just an easier time. Look at growth rates. I mean, like I said, we'll get into it because now we have earnings coming up, right? So if you take a look at the earnings this week, which will be the most pivotal earnings to define where this market goes, is obviously Microsoft and Meta. Meta, I'm still very bullish on. I like Alphabet at these valuations, but you look at Microsoft and Apple and Nvidia and these companies, and even like they just trade at extremely, extremely high values, which again, like you got to take into consideration, major investors like Buffett are just not buying these kind of stocks these days. And I mean, there's no surprise, right? Like look at Apple here. Apple's a company where this is the highest price to earnings multiple it is ever really traded at in the entire history of the company. And the earnings are slowly trickling up. But again, you go look at revenue. Revenue is non-existent. There's no revenue growth and hasn't been since we've gone into the interest rate cycle. You take a look at the shares outstanding. They've been buying shares back, but not as aggressively as a pace as they were. They've refined a little bit and they've increased their margins a little bit. Like every company's doing, right? Like just refine and dine and just kind of keep the base growth going, but it's not enough to ride on the back of AI unless people really upgrade their phones on this quarter, right? Like we need some serious growth to start justifying the multiples that we have. Again, we've talked about this, like the PE multiple expansion has just kind of been going on this escapade where everyone's all excited again. And I keep saying like, could be another like AI bubble-ish thing that we're witnessing here, right? It's just, I don't know. I'm not going to bet on it. I'm not going to short the market by any metric, but like, I'm just going to be cautious and just diversify my capital. Because again, like I'm not looking for aggressive growth like I once was. And again, we have aggressive growth. We have tech. As many of you know, like I'm only showing you my half of the portfolio. The fiance has Meta, which she's up just stupid amounts of money on. And we have a lot of tech exposure already. I just like continually diversifying and I'm moving into the preservation phase, looking for like nominal, maybe like anywhere around 8 to 12% return rates, which I look at in these ETFs that we discuss historically. But again, you have to recognize we could go into periods where growth really falters out, or if AI starts to lag or some black swan event happens or whatever. I mean, there's some concern, right? So you look at Microsoft, like Microsoft's trading, again, at the highest multiple it's ever traded at, pretty much ever. And then if you just go take a look at their like revenues, this company at least has very consistent revenue growth and it's been back to its place of normality. But if it's just growing at the same pace that it has been through 2017 up to 2020, why is it trading at like these wicked high valuations all of a sudden? Like, why is the market giving them that demand? Nvidia almost, well, basically, I think it just touched Apple's valuation, didn't it? So now like Nvidia is trading at like, Nvidia is a hard one to wrap your head around. I honestly told you guys that it was like, I thought it was, I wish I traded it because I saw it better valued when it dropped down to a 50 price multiple just a little while ago before it shot up another 20 or 30%. Because it seemed favorable, right? Because the stock is still growing like at absurd rates. But again, this is all backed on business to business, not consumer, right? So, I mean, so for as long as businesses are building AI, like they're going to be good. Like they'll be good for at least another year or two, I'd hope. But yeah, I mean, this company's surpassed Apple now. And when you look at the revenue this thing's making on the trailing 12 month is only 96 billion. That's like a third of what Apple's making, yet it's worth the same amount, right? So, I mean, like if we just go back again, you have to understand we are pricing in like really high futures into this market. So Apple's trailing 12 month is $385 billion. So again, Apple's 385 versus Nvidia's right now 96. So, I mean, just again, the margins are way higher. However, if we do some, can I find margins on here just to show a comparable? Like, let's just take a look at margins. Yeah, their operating margins, gross margin. Actually, is this? Yeah, this is Nvidia's, right? Yeah. So Nvidia's got like 75% gross margins, which is like severely. So they basically have to make, just a little bit. What's their actual like net income right now? First, I just want to see the difference here. How far does Nvidia have to go before it's going to be closer to Apple's metrics? If we go back into revenue and profit, just take a look at net income here. Net income is about $53 billion on the trailing 12 month. If we take a look at Apple here, Apple net income on the trailing 12 month is 101 billion. So I mean, Nvidia's got to double up what they're doing to even get to Apple's level, right? Which again comes with that high price to earnings multiple. So we're living in a market right now that is highly reliant on what's happening tomorrow, not what's happening today. And that's when things get quite concerning, right? I mean, you got to remember there was a time where Meta was trading in the low double-digit price to earnings multiple. I think it had like a low PE of 12. Think about it. That wasn't even that long ago. I mean, it's crazy how fast these markets fluctuate, right? Which comes back to the point of cost averaging and having an emergency fund for when the market tanks, because I don't want to be like balls to the wall when everyone's balls to the wall right now. So that's why I'm looking at my portfolio saying, hey, like, we're kind of sitting in a phase where profit taking seems more prudent to me than anything else for the most part. Like I'm going to keep buying, but the problem I have is like, as I told you, first and foremost, like our retirement goals, as mentioned, like I want to get about another 250 to 300K. That would get me to like my initial, like, I don't really need to rely on a job anymore. And it's basically because between our TFSA, like our tax-free savings accounts, we have 6 figures worth of room still. And then we owe like, I think I'd have to double check and see what we owe on the mortgage. But basically, if we can just max out our tax-free savings accounts, pay the mortgage off, then we're in a good spot. And the problem that I have is that half my portfolio right now, well, not half of it, but how much of it? I'll bet 120K is sitting in my corporate account, and it's just invested in the S&P, and it's up a lot. And I told myself at the beginning of the year that basically if anything over 100K by the end of the year in my corporate account, I was going to pull out to basically, again, pay down the mortgage. And I'm going to pay it out to my wife because my wife's in a lower income tax bracket right now. So I can pay her out. Instead of paying the corporate tax, it becomes a corporate expense. So I don't pay any tax in the corporation because I'm just expensing it because she can be an employee to the corporation. She's in a lower income tax bracket than I am. So she's going to pay a lot less than I would paying it to myself, at which we'll probably divvy it up and put half of it into her tax-free savings account and the other half into the mortgage, because I want to do another probably 15% mortgage payoff by the end of this year. And the account's pretty full to do so. So I just want to get that little bit extra so I don't drain it completely to zero. And I'm sitting in a moment right now where we're in this interest rate cut cycle that's devastating the Canadian markets. And this is, again, one of the most interesting case studies. And honestly, I wish I traded, effects right now or exchange rates, because, man, like this was so obvious when this was happening. Like anytime the Bank of Canada starts cutting, any country for that matter, that cuts more than the US is going to see a deflationary period of the currency. because that was the big risk, right? And the big fear that if Canada doesn't cut in line with the US, a lot of Canadian dollars are going to flood out of the Canadian market. It's the same thing we saw with Japan, right? Like Japan had record low interest rates. So all these Japanese people were like, hey, I can borrow money at a really decent rate because the rates haven't gone up in Japan. So let's take the cheap money we can borrow, put it in the US money market fund, let it sit there, collect cash, and we'll just pull the cash out and convert the currency. And then what happened? Japan raised the overnight interest rate, caused a complete calamity and a pull out of US dollars because they had margin loans, whatever the hell they were doing. The bank got a little concerned there, and currency fluctuations really rattled them pretty dramatically. And that's exactly what we're seeing right now with the Canadian dollar, because all these people in Canada are shoveling their money into the US market. Because if we take a look at Canada's interest rate, after that half basis point cut, we're at 3.75, whereas the US is still hovering pretty close to 5%, right? Like they're just under 5%, aren't they? It's like 4.85 or something like that. Either way, like the US interest rate is significantly higher. So people are going to make more money putting their money in US markets. So, right now is just a horrible, horrible time for the Canadian dollar. It's down like almost 4 percentage points, 3.5% from the peak of just September, literally. But look at how close this time frame is. Can I zoom in? Can you guys see that? I make sure you can see how insane this is and how short of a time period your currency lost value globally. Look at this. So just in September, September 24th, the Canadian dollar has now lost 3.41%. So if back in September, you just put all your money in US dollars, you made a 3.5% extra return. That's like a dividend payment just on the currency exchange. So that's why right now I'm like, well, the US is going to continue to lower rates as well. Why not take advantage of the lower rate? I have a lot of US dollars. I get paid in US dollars, but they've been sitting in the account. Let's convert some. Let's sell VOO, at least a little bit of it, maybe like 10, 15K worth, convert some of those US dollars, and then just take major advantage to help pay off the mortgage and continue to invest in our tax-free sheltered accounts, right? So that's kind of the goal here. How low could the CAD get? I'm hoping when the US starts cutting, it's not going to get much lower. But if we keep cutting more aggressively than the US, then this is a huge concern, right? Like this is a terrifying thing that is primarily largely driven by political bullshit. And this is just like a horrible rendition of we need more money coming into our country. And I wish they did a better job of this. Cause since 2008, like a Canadian dollar is down by like 31%. And this is why I advocate diversifying currencies so much, because even against the euro, you can buy like euro stocks and euro currency and get euro. I've been debating on doing it in my corporate account, but it's just something that you should really consider if you're looking for like really longevity in your cash. It's not, you can just buy obviously my paranoia takes it to a new level, but you can obviously just buy a global like stock fund or whatever, like what's a good ticker for that? Like just a global market fund, which most people think is like an end all be all solution. And it is. But the problem is if your local currency collapses, you're converting all those dollars to your local currency, which you might not want. Because again, like I can spend US dollars in Canada. I can spend US dollars in Europe. Most countries will accept US dollars. Hell, most countries don't even want their own currency. We were in Turkey, and Turkey doesn't even want to accept their own currency. They want your foreign dollars. So I'm just saying, like, you just want to be very careful with some of this stuff. So it never hurts to, take advantage of the lower dollar and make an extra 3.5 percentage points and pay that mortgage down, baby. Pay it down. See what I can do. I sold BAM, was up 75%. Oh, congrats, man. Like I said, I'm not trying to like push anyone into taking profit or anything like that. I'm not like, I always come off as more of a bear, as more hesitant. Like obviously I'm a little bit more speculative that this market is a little overvalued. It's a little speculative in nature. We're very forward pushing valuations, which means things have to be perfect, and things are never perfect. We saw that through the crypto crash and all this shit. And as mentioned, I just think we're in a new era of the market. I think we're in an era of like volatility, right? Like ever since, this is just what happens when you print an ungodly amount of money in the mix of like geopolitical events, in the mix of like pandemics. Like ever since the pandemic, it's been a wild roller coaster. And I think we're continuing to be in this roller coaster. One of my big predictions, even back here, I was saying, like, I think we're going to see higher ups and higher or lower lows. And I think we're going to see a lot more volatility moving forward. And I still don't think we're on the other side of the storm yet, right? Like we just went through the eye of it. Now we're coming out on the other half of it. And we still got to get through the interest rate cuts, get back to a more nominal market, see what the geopolitical events start to do, the next election cycle. Like there's just so much going on. But again, that shouldn't stop you from investing, right? But like I said, if you go back and you just look at 2010 onward, and it was such a good time period to be alive. Oh man, what a great time period. I wish I could go back. I honestly, like, I mean, even look at like, let me give you another good example here. I mean, look at like Apple, for example. I mean, Apple had, pretty consistent growth, even like all these companies, they were just so much more consistent, during that time frame. What's going on here, guys? What are you guys talking about? I just wonder how much power will be needed for all the AI. A lot of power. That's why it's still good to invest in utilities, right? Uranium. Yeah. So uranium, it's an interesting thing, just, from a risk standpoint. It's such a fascinating, world if we're going to really push uranium, because we still haven't really pushed it as hard as China is. But yeah, it's gonna be neat to see how the uranium play really evolves, because the demand has shot up so dramatically, and we're not seeing nearly the same uranium race in the U.S. as we have been in other countries. Hydro One, yeah, Hydro One's been on fire. I like Hydro One because there's just an infinite amount of houses that need to be built in Ontario. For those of you that don't know, like if you're into utilities, Hydro One, like they basically own a huge percentage of the transmission lines. They supply like millions of homes, the transmission lines. So like, and it's a government spinoff where the government still owns a huge percentage of it. So it's got such a consistent return. It's like anytime it gets close to 3%, you should it's a good dip buying kind of a stock. Sorry, I over zoomed in here. Yeah, it's a really good dip buying stock if you can take advantage when it drops, if you're into that. But you could just buy a utility ETF too. You don't have to just buy the one. I mean, Fortis is still pretty good. There's a lot of good ones out there. But yeah, Hydro One, just purely, if you can go somewhere where there's just endless amount of homes being built that need hydro supply, yeah, it's pretty hard to lose that growth. You could really pick that up with Hydro One. You picked up some Uranium Royalty. Man, I used to work with that guy, the guy that the CEO of Uranium Royalty Corp. I don't know if I still have the videos up, but if you go back like really early days of my channel, I was interviewing this guy back when uranium was a little bit more suppressed, and I'm shocked that it's not higher than it is right now. I don't know if the price to earnings matters as much, because a lot of these uranium companies, the values in their stock supply, because what people don't realize is another reason that uranium has shot up so much is companies like they order this stuff in bulk. Like they just order huge amounts of this stuff. So it kind of goes through like ebb and flow periods. I've talked to a bunch of uranium guys. Like I don't know if it's Uranium Royalty Corp or I'm pretty sure it's Uranium Royalty Corp. Don't they have like thousands of like pounds or tons of this shit just laying around in some warehouse somewhere? Developers are being told there isn't enough power to connect to certain subdivisions. Demand will only increase. No, I agree. I think, this is why, again, utilities are such a good investment, right? There's nothing wrong with the utility investment. But again, even if you're buying tech right now, you're kind of getting utility investments. I mean, Tesla is technically becoming a utility. I mean, Microsoft is buying nuclear power plants. I mean, we're heading into a very intriguing world. How much dividends would you need to live on? I'm not purely looking to rely on dividends. Ideally, the goal would be to get enough dividends to cover the base expense, but use capital gains to really pay for stuff when the market's doing well. I mean, again, that's what we did for my parents, basically. Like I told my mom, let's just get your basic bills paid with like reliable dividends and ETF stocks, like really, really reliable stuff. And then let's just do it as safely as humanly possible. And then anything thereafter, your bare minimum of like cost of living, then we go, growth. Then we go into things that don't pay as high yields, because, then you use that extra little income to expend it on whatever. And when the market does as well as it's done, take some off, treat yourself. It's the best thing you can do. But yeah, it depends. I mean, this is an easy question. For me to live off dividends, I need about 30,000, give or take, probably less than that, but around 30K, I would think. I think I ran the math on this before, because our total expenses are around like 45,000. But you got to keep in mind, for our mortgage, I think we're paying like, how much are we paying? About 1,400 a month, I think, for the mortgage. If I'm not, no. It's more than that. How much is the mortgage on its own? Like just the, I'm just trying to think. 612. I think it's like 1,200 a month or something like that. I'm just trying to put all the math together here. 1,200 times 12. So if I pay that off, I'm saving 14,000. So yeah, I mean, probably around 30,000 or less would probably get us covered, which again, so if we get 600K, I think all we need is 6, isn't it? What, 5, 10, 15, 20, 25, 30. Yeah. So, I mean, if we got 600K at 5%, which I probably won't get 5%, because that's why I said I'd like to get closer to 7, because I think it's more easier to get a 3 to 4% yield with the stocks that I like buying. But yeah, I'm close, man. We're super close, which is surprising. It came a lot quicker than I would have thought. Did you watch Trump on Joe Rogan? I did. It was interesting. I won't get too much into my opinions about it, but yeah, I watch a lot of the debates. I love watching this stuff and just taking it in. I don't like getting as argumentative. Me and my buddies will argue, 9 ways to hell about it, but I kind of enjoy the arguing. But in the States and with some friends, you can't argue about it because they take it too personally. I still regret not buying Cameco a few years ago. It was $12 a share. Now it's around. See, this is the problem I have with these stocks sometimes too, right? Like I look back and I'm like, oh, I wish I bought it. Like one of those examples was the LAC. But then it's like, well, if you didn't sell it and take profit, I mean, look at Lithium America Corp. I mean, I remember back in the day, this thing when I was trading it for around $1 to $2. And then when it shot up, I was like, man, I wish I bought this. I wish I bought this because I had it. I traded it. And now look, it's like back down to like $2 to $3. So same thing with Canopy and a lot of these stocks. You got to understand a lot of these individual stocks you got to be on the ball with. This is why I don't like dividend investors and this like end all be all that we can just hold these stocks forever without management. Because again, I mean, go look at the S&P back in the 80s and 90s and look at it today. Like, there's just so much that sometimes with individual stocks, you got to be a bit careful. I mean, we have our long-term bets. Like, again, we've been holding Meta for years. We've been holding some stocks, but like I said, you got to be a bit careful with managing it. Because a lot of people just think you can set and forget that shit. And they think, oh, well, look at like Forrest Gump in that movie. She bought Apple shares like a decade prior, but most people don't have the balls to hold it for that long once it's shot up 1,000%. And the other thing too, is most companies end up like Lithium America Corp, where they shoot up and they go right back down. I mean, you got just this management. You got to be able to manage your portfolio properly. I'm going to sell Apple soon. Yeah, I did that way too early. I made the mistake. But again, I bought it in the S&P 500. So again, don't sell stocks because I'm telling you, there's nothing wrong with Apple. It's probably a great long-term hold. Just depends on what your goals are right now, right? Kyle saw the Charger at auction cheap. What are Chargers going for, man? I used to have a Chargers. I'm presuming that's what you're talking about, right? Like, let's just take a look at Dodge Charger on Auto Trader and see what they're selling for. I don't want a 23 might be a little expensive. Yeah, 40 to 46 or 96. Yeah, I was buying these for like 8 to 10K, man. They used to be so cheap. And same even with like, the car that I have now, like these aren't that cheap. These are pretty expensive for 2021. Yeah, these are like highly, here's one for 36. I guess it's not terrible. 23 is not bad for 2016, but man, still very expensive. They were so much cheaper, I think, back in the day. RioCan, baby's coming back. The Canadian REITs have done very well. I got to give the wife credit for also still holding the RioCan, because I did not. Let's take a look here. RioCan, what's it doing here? It should be coming back. Yeah, they're starting to correct a little bit after that more recent jump. But I mean, we were coming. That's the US. What's the Canadian stock version, RioCan? I need to look it up in Yahoo Finance. I hate that it doesn't pull it up properly. Yeah, because I think on the Canadian dollar, it's doing much better. Yeah, I mean, it's come up quite a nice little bit here. I mean, we were buying in the pandemic, right? I leveraged. Only time I've ever used leverage was to buy RioCan during the pandemic, because everyone gave up on everything. And I was like, wait, what a great time to buy. Then we sold it somewhere up here, somewhere around here we sold it. But the wife's still holding it. She's got the cojones to keep that going. Love to give you a shout out here from the beginning. I always appreciate it, brother. We need to do a video on account prioritization for Canadians. What accounts max first? I mean, you want to max your TFSAs, then your RRSPs, but you can do both, right? Because at least the RRSP gives you a tax deduction. But yeah, max both those accounts out first. And then if you want to get really finicky and really genius with it, you got to go open up a corporate investing account, start a business and start taking advantage of write-offs, and then invest in a corporate account and then sever some of the liability. I mean, that's the best thing to do. I mean, I've been meeting people lately that open up multiple like LLCs and shit and all kinds of different corporate accounts that they manage multiple assets through just to like alleviate basically anonymity. Like they'll hold certain things in certain accounts so they don't know who's holding it. Like they keep these accounts pretty anonymous and they hold it through like a bunch of different people. It's really interesting. Some people get crazy with it. Had to grip my teeth with RioCan. Glad I held on. They made a gutsy decision to cut the dividend in order. Yeah, they did. But again, RioCan's underperformed the market over the long run. If you want income, there's nothing wrong with REITs. Like, again, we hold them in my parents' account. It just comes back to that point. If you don't need income today, I wouldn't necessarily focus on them as much as like growth, depending on what you're after. Don't forget to invest in your FHSA. Yeah, I already bought a house, so I couldn't take advantage of that. Unfortunately, it came out right at the same time we were buying, but I thought I was going to be crafty and it just came out. I was like, man, if I just put the money in there, it becomes tax deducted and then I can pull it out, but it doesn't. It was just too much of a headache to save a couple grand. So I said, forget it. because there's only a limited amount you can put in it too, right? So it's kind of annoying that way. And yeah, I don't know. It's a weird account. The only good thing about it is unlike, because I didn't touch my RSP because I didn't want to pay the tax or have to pay the account back. Because when you're buying a house, you can pull the money out of your RSP as a short-term personal loan at no interest, but you have to pay it back over a certain period of time. And I'm like, I don't want to double loan myself. I'd rather just do it properly. But the FHSA is basically an RSP without having to pay it back. If you cash out your TFSA, contributions 1 week before the end of the year, you can reinvest the contribution next year if you need that cash. Yeah, and it increases your room as well, right? Not that it really matters unless you start pulling it out again. But yeah, I mean, if you want to lock in the contribution room, because yeah, it basically, and that's what we're doing, right? Like, I pulled out 180, 200. I don't even remember how much was in my TFSA, a lot. But I completely sold it all out. Now I can put it all back in this year, which is what we've been doing and rebuilding it back, right? But yeah, it's a good way too to lock in the minimum amount your TFSA is worth. So because if your account goes down a lot to some extent, I don't know, it doesn't really matter, but it's just something you can do, I guess, if you want to have some fun. 10K TFSA contribution would be a dream. I don't think we're getting that. I think we'll probably get 7,500 again next year. I hope so. It was 10K for 1 year, I believe, in a drop. We'll see. It'd be nice if they jumped. They might, if they appreciate Canadians and they're like, we'll help you out. It's been a tough couple of years. Couple of years, 100 G's each in SCHD and VDY. Good idea. That's what I'm trying to do, bud. Right now, how much do I have in VDY? I've got 95,000 in SCHD. I've almost got my 100K goal. I'll probably either be there if it jumps up another couple percentage points, or if I just get to next year with my RSP contribution room, that'll be maxed out. And then I've got 44,000 in VDY. What I might start doing, because I don't want to overweight Royal Bank in some of those stocks, once I get it to maybe 70 to 80K, I might put a little bit into like XDIV or some of the other Canadian dividend ETFs just to diversify it a little bit. Because I think if I get 100K in VDY, Royal Bank will be the largest position in my portfolio just from the weighting, which I'm not like the big, against, but I'd like to keep it fairly equal weighted. Mark my words, Kyle, your RSP will grow too much and you'll have to melt down to avoid mandatory withdrawals. Well, I mean, by the time I'm 65, I think you have to mandatory withdrawal it, right? But again, like my short term, and then you can switch it over to a different account where you can pull it out. There's another account that it becomes, and then you have to pull it out over a certain amount of years, which is what you're going to want to do to avoid paying like a stupid amount of income tax on it. But my goal with my RRSP is to primarily, by the time I'm about 35 or 40, to start pulling the dividends out. And I'll use the dividends as taxable income, and hopefully I'll just pay a tax on it, whatever, and spend it, and then do that for 20 years. And then SCHD will hopefully continue to grow. And then by the time I get to 65, then comes the finicky shit. Now I'm going to have to pay the tax on the full amount and start actually pulling it out to some extent, which I'll figure out when I get to that point. But I mean, again, we're talking about like 35 years from now, man. I'm like literally, or isn't it 70? I think you have to wait till you're 70, right? I think you can make it to 70. Yeah, no, 71. Yeah. Yeah. So I mean, like I literally have like 40 years before I'm 32. So what is that? 40, 50, 60, 70? Yeah, literally 40 years. So yeah, it's called a RIF, I think is what it becomes after the fact. So I'm not in a big rush for that. You can defer a bit of it to your spouse if you're younger or whatever. Yeah. So I mean, yeah, we got some time, man. But I think that's the appropriate thing to do. And I love the RSP. I argue with people still tooth and nail about the value of that account. Because a lot of people are like, oh, RSP, like you still get screwed when you take it out later. It's like, yeah, no shit. But you do it when you're in a lower income tax bracket. Like I'd be dumb to pull it out right now. That's why I'm paying my wife for my corporate account, because like I'd be paying like a 40%. I'm in like I think a 40% tax bracket right now, whereas my wife I think is still at like a 29%. So this is like you could just wait. And then like I said, and the cool thing is if we max out our TFSAs between me and the fiance, like that's going to be like half our portfolio. Like we'll have well over a few hundred K. Like our contribution room and our tax-free savings accounts are insane because we've grown them so much over the last decades. I mean, we've got I think close to 400K between us or something like that. So half our income will be 100% tax-free. And then we'll pull the rest out, which will be in a super low tax bracket if we're pulling it out of our RSP or whatever. I mean, we got lots of options, a lot of opportunity. Insane compounding, 35 years indexes, ETFs will make multimillionaire. Yeah, I mean, that's the goal, right? So try and get dividends out of ETFs and they just never touch the principal. See where you end up because you're still going to get good growth. And it's not like I'm going to quit working. Fuck, I'm not going to like actually use the dividends probably. People forget about the basic personal amount. Yeah. But what else is going on, guys? We'll finish up here soon and then maybe do a Halloween stream or something. I don't know. I feel bad because I know I'm not going to be around for Halloween and I'm like, got to do something cool, man. We got to have some fun with this. Investing in U.S. stocks in an RSP is tax sheltered, but doing so in a TFSA is not. So your TFSA should be invested in Canadian stocks only, just PCA. I do not agree with this. I think you shouldn't hold U.S. dividend stocks in your TFSA, but I would own U.S. growth stocks because the tax gains are 100% tax free. There's no withholding tax. So yeah, don't be fooled and don't get caught in that trap either. You could easily own the S&P or QQQ or whatever and split it between Canadian stocks and US stocks, which is what I do. And then I keep SCHD in my RSP because the dividends are 100% tax free with no withholding. So just be a little careful with that. Have you considered UL policy owned by Corp to get tax-free Visa Canadian accounts? I have not looked into that, but it's something I could do. No tax on your first 15-ish%. People forget about basic personal amount. Thought on holding USA ETFs that trade in Canadian dollars. Yeah, like VFV and stuff like that. But again, I'd prefer keeping US dollars and USD. Because like I said, so if I was holding VFV as an example, when it pays a dividend, you're automatically getting the converted Canadian dividend. I don't want the automatically converted Canadian dividend. That's the problem with VFV and some of these Canadian pure converted stocks. So just be careful with that, right? Because look at the situation now. Because I own a lot of US stocks that I'm not converting right now, that the Canadian dollar is so shitty, I can take some dividends in my cash and all that and actually control it when the US dollar is better and more favorable. It gives you a bit more control, I guess. But yeah, otherwise, folks, there's a lot going on, man. There's too much going on. I don't know how you guys are dealing with this. Most of you guys watching this, I'm sure, are Canadians. So respectively, there are more perks to corps than there's more perks to a corp you are not taking advantage of. Ben Field. Yeah, I'll have to deep dive. Honestly, there's so much stuff you can do with a corporation that I know I'm not taking advantage of, but I'm one dude. I figured out so much already on my own, bro. I opened up an entire corporate investing account. I am like the CFO, CEO, operation officer. I'm everything in one. If you've ever opened up a corporation on your own, you'll figure that out. That you got to figure out all your titles and everything, and it's such a headache. But yeah, teach me, man. I don't know it all. Teach me. Sorry, you're interviewing Jaguar Mining CFO. Are you a shareholder of Jaguar Mining? Excuse me. I got hiccups now. I'm dying here, folks. No, I work with I think 80 different companies right now. You don't see a lot of them on my channel. I do have other channels that I post to where I primarily do those interviews. Oh my goodness, folks. There's a psychological thing I learned where I can think my hiccups away. If I consciously make the decision to not have hiccups anymore, I'm hoping they just go away. But yeah, no. So I have another channel where I post a lot of interviews, but I personally work with about 70 or 80 companies, I think, right now. Through my actual job. So you might see those interviews pop up now and again, especially for some of these companies if you're interested in them. Jaguar is doing pretty good right now, though, man. A lot of the mining companies are. Should I get SoFi stock right now? I don't know. Do you like SoFi? What screen am I sharing here? Let me look it up. I know a lot of people are buying it. I don't know. Do you like SoFi a lot? I know it tanked and now it's kind of coming back, but I don't know. I feel like SoFi is another one of these kind of hype stocks. A lot of the Palantards like to talk about. Do you have Discord? No, I do have a WhatsApp chat group, though. Right now, the USA exchange rate is too high. Would you wait a bit to keep... honestly, if I was going to buy US stocks right now, I would just buy them and not care about the exchange rate because it's cost averaging. But for me personally, like I said, I'm going to convert because I have so much US dollars, even in cash. Like some of that 16,000 that's in my cash, like half of that is just in US dollars. Minute books, etc. I did this about 10 years before you and still learning, but the government is hitting us hard and closing loopholes. They are closing loopholes, but is your chat group public? No, you have to go into my Patreon. But honestly, I'm thinking about trying to figure out a better way of communicating with you guys because I've started meeting up with people in my WhatsApp group and some of you guys to just personally communicate, and it's been great. And a lot of you probably don't even know about it because I don't promote my Patreon at all. And you don't have to subscribe to it, but if you just want to get the WhatsApp link, I mean, it's in that group. Oh my God, guys, I'm dying. I'm struggling with dividends in our SP. Our tax is regular income. Whereas, oh my goodness, guys, I'm so bad. Jesus Christ. Are you talking about the RSP or taxed at regular income, whereas in a no register account or taxed at a lower amount? I'm not sure what you mean by that. Because the whole point, RSP, or are you talking about an RRSP? Oh my goodness, folks, because in an RSP, man, it's tax free until you pull it out. How do you convert without paying the 1.5% fee? What do you mean? How do I pull it out without paying a 1.5% fee? Royal Bank doesn't charge me on conversions. Royal Bank, actually, if you have business accounts, and a lot of the banks, they don't actually charge you a conversion fee. Royal Bank doesn't charge any conversion fee if you're a client. So I can convert currency without issue, if you're wondering. What do you prefer on your standard account, not RSP or TFSA, if you put money into VDY? So in a personal account, to be fair, and this is probably, again, if you're just looking for the most appropriate way, the most tax efficient way, I would purely just put it in something like Berkshire Hathaway or something that doesn't pay a dividend, and then just take capital gains when you need the money. Because VDY, even though you're more tax efficient with VDY for the dividends, because the Canadian government gives you a discount on Canadian companies that make cash, more than 50% of their income in Canada. So Canadian qualified dividends are only taxed, I think, like 15% or something like that. It's a very low tax rate. So you could do that if you're buying it in a regular account, if you need the income. But if you're only looking for growth and you don't want to pay tax, you're better off just buying growth-oriented stocks, because then you pay way less. Because I think on growth stocks, you only pay 50% of the capital gains are tax-free. Fear may cure hiccups. Imagine Trudeau winning another election. You're making my hiccups worse, bro. Oh my goodness. Here, let me reinflate my rocket ship so we can have a little send off here before I finish the stream up. Because we're the Rocket Man, baby. We're going to the moon. Let me put some more Halloween music on so we can finish this up the way Halloween's intended to be. Rocket my way up here, folks. Here we go. Got to put the good music on. All right, let's go. Anyways, folks, stay cool, stay awesome. And as always, I look forward to catching you in the next one.